Hi there, I'm Lindsay Biscaya. Welcome to Market Call. Jamie Murray is on the show today. He is president of Murray Wealth Group, and we'll be taking your questions on global equities. Here's how you can reach us. You can call us toll free, 1-855-326-6266, or you can send an email to marketcall@bnnbloomberg.ca. And Jamie joins us in studio. It's great to have you in. Good morning.
Thanks for having me.
Okay, so it's been a couple of interesting weeks or months, I guess, when it comes to the markets. Lots of volatility. You're feeling optimistic, though, and you say that's mostly because of what we've been seeing from earnings.
Yeah, exactly. So we're actually seeing earnings estimates broadly for the S&P 500 at least to continue to climb and actually accelerate a little bit through March and into April. So underneath the surface, despite the macro headlines, we're still seeing corporations do quite well. There's a few reasons. I think first off, like the AI trade is still a little bit, it's not really affected by the oil prices spiking. It's not really affected by the consumer slowdown. It's really secular adoption that we're seeing. And so that for us is one of the main drivers of the market. And then, even just on the consumer side, we haven't really seen the consumer slow down too much despite the higher gas prices.
And when you're talking about AI, we'll get to the higher gas prices in a moment, but when you're talking about AI and like the kind of build out of infrastructure, there's a way to kind of navigate this cycle that you feel like investors should be paying attention to. What is that? Yeah,
we really like investing right across the AI value chain because it still is an emerging technology. We're not sure where all the value is going to accrue to. Certainly the chip stocks like NVIDIA, Broadcom were early to this. Now we're seeing the Anthropics and OpenAI, the actual model companies, really start to see revenue accelerate and earnings growth accelerate. But at the end of the day, AI is going to flow through the whole ecosystem of the economy, and it's going to benefit corporations like insurance companies, financial companies, consumer companies. And so it's really seeing where is it going to actually impact the most. And so just being spread out right across the theme is the way that we're playing it.
And there are different themes, right? Like, as you say, like there's different companies that really seem to start to be benefiting from the AI build out. When you look at, semiconductors, chip manufacturers, it's interesting to see how the story changes with AI throughout the months and years as we get progressively more involved in it.
Yeah, and exactly. And when we're in these like super strong growth periods, you'll see a lot of volatility. And we also see, as much as you see the amazing growth from these semiconductor companies and the suppliers into them, you also get these violent pullbacks where investors get shook out of the trade very, very easily when there's the first sign of, maybe the AI trade is not going to go on as long as we think, or it's going to be as strong as we initially believed. And so that does provide trading opportunities around those events as well.
The one wild card, though, and you touched on this, is the higher gas prices. But the one wild card in your eyes is that conflict in the Middle East, that ongoing conflict.
Yeah. So we've seen the oil price move up. It's around $100, $110. Moves $5 to $10 every week, it seems, in one direction or the other. And then we get the political noise. We get Trump and Iran saying, oh, yeah, we have a deal. No, we don't have a deal. We're going to go back to war. We're going to blockade the strait. So it's extremely volatile scenario, but it's really binary at the end. Either the strait and oil is going to flow and open, and the economy will probably do okay in that, or this drags on longer than the market believes, and the oil price futures curve actually prices in oil prices coming down substantially into the back half of the year. So the market doesn't think this is a long-term event. And if that proves to be wrong, then we could actually see a more severe oil price spike to $150, $200 a barrel. And that we think would actually start to impact the economy underlying.
Certain sectors that it would really start to impact, or kind of everywhere?
It would be much more broad. certainly like the travel sector, airlines,
Yes.
And we're hearing about, are there going to be, a lot of my colleagues are traveling to Europe this summer, and they're like, I don't know if I'm going to be able to get home. I'm like, well, I think you're just looking for an excuse to stay in the French Riviera for another couple of weeks. But no, certainly there's concerns around flights. We are seeing flight bookings and the number of flights overall come down. But if it starts to flow into the consumer, especially in the US, that's when we'll really start to feel it.
For sure. Okay, we're going to take a quick break. We'll be back, though, with Jamie Murray of Murray Wealth Group, taking your questions on global equities right after this. Here's how you can reach us. Welcome back to Market Call. Jamie Murray is here taking your questions, and we're going to get started with an email question. This one's coming in from Jean, and it is about Alimentation Couche-Tard. It says ATD, which is one of the world's largest gas retailers. They surely are one of the greatest beneficiaries of surging gas prices. Can you comment? So are they? What do you think?
Yeah, so interestingly enough, I did meet with the management team a couple of months ago when this crisis was pretty fresh, and their view's a little more nuanced. They think when gas prices are high, certainly they might make more on what they sell. It depends on, they have to buy the gas and then resell it. So it's really about the margin of gas prices. And then there's the other factor, when gas prices are higher, consumers actually don't necessarily fill up their tank because they don't want to spend the $100. They just want to throw in 30, 40 bucks. So they actually come back more frequently. And that ultimately drives more visits, more snack sales, more cigarette, alcohol sales, and where they're allowed to sell those. So it's probably a net positive. Either way, it's a very strong company, as she mentioned. The biggest reason you want to own this is for their acquisition prowess. They've done numerous acquisitions over the years and grown into the largest convenience store gas chain in the world. And you're looking for more of that really to drive the stock further. But certainly it's a nice low beta company that's not going to be affected by oil prices in the same way other consumer companies could be.
Yeah, for sure. Okay, we're going to go back to the phone lines. Rob is calling in from Calgary with a question. Hi, Rob. What's your question?
Hi. Thanks for taking my call. I'm a long-time holder of Quarterhill, and I know it's not really a global stock, but I'm hoping you can offer your opinion on it. In my opinion, the stock's been a chronic underperformer, and it's recently had, it has had a 3-month rally and a movement towards profitability. Jamie, do you see this rally continuing, and what do you think of Quarterhill's future prospects? Thanks again, and have a good afternoon.
Okay, thanks for your question. What do you think of Quarterhill? And also, we actually don't talk about this company very often.
Yeah, so Quarterhill, it's a small cap company. We're familiar with it. We actually own the debentures. So in 2021, they did a convertible bond issuance, and that's what we own in our income fund, growth fund. And they do technology for transportation, highways, sensors, way stations. And so it is a business in the right part of the market as we move more towards technology and edge AI moving into every part of what we do. But it has been a chronic underperformer. They didn't really deliver on the initial growth that they have, but the stock has rebounded. They have had a little bit better sales momentum. When I see the consensus for the analysts, they're looking for 10% revenue growth the next couple of years, which is a change from the last 3 or 4 years where revenue is pretty lumpy. So it is a chunky revenue stock. They get these contracts, the revenue flows through, and then that ends. So it's not one that we're looking at buying today. And when the debentures come up for maturity, we'll just probably let them be redeemed.
Do you like small caps? Are you? Because I know there was a conversation this year that small caps are really going to have their moment. Do you believe that?
So we generally invest more in large cap in our global equity fund, which is our larger fund, is obviously global, looking for bigger companies. But there are always, in good markets and bad markets, there's always opportunities in small caps. And it's just really finding the right ones at the right part of the cycle, I think.
Got it. Okay, back to the phone lines. Ron is calling in from Edmonton with a question. Hi, Ron. Good morning.
Oh, hi. Yeah, thanks for taking my call, Jamie. 5N Plus, came across it on the weekend. Wondering if you could fill me in on the background of this company and where you see it going in the next 2 to 5 years.
Okay. Thank you for that.
Yeah, thanks. So 5N Plus is a really interesting company. They do some rare minerals and critical minerals that are not often found in both North American-based companies. It's a lot of competitors are in China or other parts of the world. And they sell into 3 different markets that have some good structural growth. So one, they provide some of these components onto satellites. And obviously space right now is one of the big investable areas in the market. And so they're benefiting from just an overall increase in space activity and selling more into that market. As well, they sell some of the components for solar panels, and they have a big contract with one of the large U.S. solar companies. And so that's been a nice business as well for them. So they have a lot of exposure to these growth industries. It's one of the only ways to play it. And they don't have a lot of competitors globally. It's a lot out of China. On the satellite business, there's some in Germany as well, but they're very tightly controlled markets. And so they're benefiting from the end markets accelerating and seeing the revenue and margins flow through that.
Okay. Bob now calling in from Toronto with a question. Hi, Bob. What's your question?
Yeah, hi, Lindsay. Hi, Jamie. Jamie, I'm wondering if you can give me your opinion on TC Energy. It's done very, very well for me, and I'm just concerned that it's a little bit overbought, not a little bit, but a lot overbought. I may take a bit of a dive. So your opinion would be greatly appreciated. Thanks a lot.
Okay. Thanks for that question. TC Energy used to be TransCanada Pipeline, of course.
Yeah, so we don't own any TC Energy. We own Enbridge. We own a couple of other midstreams like Pembina. And so we don't own it. But I mean, if you look at the stock chart, that's probably been a mistake on our end. It's doubled in the last 2.5 years. They're, again, another company that's really positioned where you want to be. So natural gas infrastructure, natural gas demand and the growth of supply is continue to explode like year after year. It just increases every year. And then on the other side, they have the power side and really the big nuclear plants here in Ontario. They're going to be building out more and more reactors over the next, I think, 2 decades. So that's just going to be a long-term tailwind for TC. And so it is the most expensive of the midstream companies. If you're looking at, do I buy TC or do I Enbridge? It's the most richly valued, probably for those good reasons. I'm not so much worried about a pullback, though, short term. I think could it fall 5-10%? Sure, any stock can. But I think if you own it and you have that long-term view and you like that dividend, I would just continue to hold it.
Okay, we're going to take a quick break right now. We'll be back, though, with Jamie Murray of Murray Wealth Group, taking your questions on global equities right after this. Stay with us. Welcome back to Market Call. Jamie Murray is here taking your questions on global equities. We've got an email question coming in from Freddie, so we'll go to that first. And it reads, please give your opinion on ARC Resources and a price target. Thank you. Okay, ARC Resources. You like this one?
Yeah, so ARC Resources is actually being acquired by Shell Canada for the LNG plant. And so I haven't checked the stock price in the last couple of days, but I'm assuming it's trading pretty close to where the takeout price is ultimately going to settle. So you can see that big jump up at the end of April. That was the acquisition announcement. So we didn't own ARC at the time of the buyout. We have owned it in the past at various times. We actually own Whitecap in our income growth fund. Whitecap's a very comparable company to ARC, a little bit smaller maybe in some regards in terms of their Montney build out, but right in that mid-cap Canadian company. They're doing all the right things. They're beating their production guidance. They're bringing their costs down, and they're integrating Varen, which is another large Canadian company that Whitecap bought last year. So that's where we'd be looking to put money in. I think our Whitecap target price is around $18, and that could certainly go higher if oil prices stay up in the $80 to $90, $100 range. And
so you like Whitecap better? You prefer this company just because it sounds like they've got a little more going on, or what's the reason?
Yeah, so if we back up about 6 to 9 months, ARC Resources had a big build out they're doing called Atachi, and actually had some wells that underperformed. And so the asset didn't really deliver or wasn't delivering how investors were hoping. And so Whitecap on the other end was, beating and raising, executing at a very, very high level. So we just preferred Whitecap over ARC. And I think now is still a good time to get into Whitecap if you have a positive view on energy.
Yeah, looks like it. Okay, we're going to go back to the phone lines. Carl is calling in from Toronto with a question. Hi, Carl. What's your question?
Hi, Lindsay. Thanks for taking my call. Jamie, about 6 months ago, you spoke about Propel Holdings, and you generally had a positive viewpoint on the company. But as you're probably aware, the stock price has struggled since then. A few weeks ago, they released what looked to be solid earnings. They raised their dividend. The stock price recovered somewhat, but has now fallen back again. And I think the problem is that investors seem to be linking Propel with GoEasy. That's had some significant issues. So I think that's unfair, too, because the companies are don't have that much in common. So I'd appreciate your views of Propel going forward, and would you be buying it at these discount prices? Thank you very much. Have a great day.
Thanks, Carl. Do you feel like that's the reason maybe the stock price has gone down for Propel Holdings?
I think it's part of it, maybe earlier on in the year. Certainly the pullback in the last couple of weeks, I think it's really just due to some concerns around the U.S. consumer. So Propel lends to very low-quality credit quality consumers, mostly in the United States. They have a UK business as well. They did have some tough quarters in the back half of 2025, but they came through that. As Carl said, they had a really good Q1 just put out a couple of weeks ago. And yeah, this is a stock, we're buying it today. We started a position just around the $20 level in our income fund. We see a very strong dividend growth profile. They've raised their dividend maybe about 7-8% per quarter, so not per year, per quarter, and they've indicated that that's going to continue going forward. And then they have a few large programs ramping up where they're actually getting third-party capital, so it's not Propel's own money they're lending. They're getting large investments from outside investors, and that's what they're actually going to use to fund the loans that they make. And so, I think that's going to see growth accelerate in the back half of the year. It trades at a very, very low multiple. I think it's a 6 times PE. So this could easily, you're either going to get 15, 20, 30% EPS growth and the PE multiple stay the same. Or if the bull case plays out and it goes to a 8, 9, 10 times PE, you could get 60, 70% returns on this company over the next 12 to 18 months.
Wow. Okay. Back to the phone lines we go. Dave is calling in from Toronto with a question. Hi, Dave.
Hi, how you doing?
We're great. How are you?
I'm good. I just had a question about Eli Lilly that's gone up recently, but just was wondering if you hold it and you think it's attractive at this point. It's like a strong growth healthcare company, and if not, what's your pick in the healthcare sector? Because it's kind of been left for dead, and maybe it might be a good time to rotate into that.
Okay. Thank you for that question. Appreciate it. Eli Lilly, or do you have something else in the healthcare sector?
We like Eli Lilly. We've owned this for a long time in our growth fund. It is the leader in GLP-1, so weight loss drugs. And every week, every year, it seems like there's a new condition that these drugs can treat, whether it's sleep apnea issues or now even in certain types of cancer, they're finding that's beneficial. So it really is a bit of a miracle drug, and it's still early in the whole development of this. And Eli Lilly is the leader, so that's one that we're sticking with. It is expensive. It's a smaller weight now in our portfolio, but we definitely like it. If you're looking for a beat-up healthcare stock, one we're looking at is Thermo Fisher. So this is more of a tools and consumables play across the whole healthcare sector. So they sell to pharmaceutical companies. So broad exposure. You can see on the chart, it's pretty beat up since the start of the year. We have, I think, a $575 target on this stock. So that's one I'd be looking at. I'd be looking to play a recovery in
a good
healthcare.
option to buy on the dip.
Yeah, it's a big company, lower risk. Yeah.
Do you agree with, Dave was saying he feels as though the healthcare sector has been kind of left for dead. Do you agree with that assessment?
It has in some cases. Like Eli Lilly is, I think, more of an outlier. We also like AstraZeneca as our larger drug holding in the sector. But certainly there's still a bit of a COVID overhang where capacity rose too quickly in COVID, and all these companies had way too much capacity, and we're still working through inventory. There's also been slowdowns in China where a lot of companies have big operations, and then we've seen the U.S. government, pull back spending on their healthcare programs. So it's been a little bit of a triple whammy, but ultimately, the population is aging, the medical needs are increasing, so we think it's a good entry point.
Okay. JC is calling in now from North Bay, Ontario, with a question. Hi there. What's your question?
Hi. I like to diversify into a little bit lesser known dividend plays, and one of them I've owned for a long time is Doman Building Materials. I know you mentioned it bullishly last time you were on. What do you think about it and the kind of slowing housing market, but also the increase in construction for new homes? How do you think that'll play out for Doman?
Okay. Thanks, JC.
Yeah, so as JC said, we own Doman. We really like the company. I think if you put Doman's stock price chart up over any other forestry or wood products company over a decade, you'll see through a cycle, it really outperforms. You get a nice dividend. I think the dividend yield today is around 4.5%, 5%. It's been higher than that as the share price is lower. And so this is just a well-run company. They're a little bit more of I call them the midstream of the forestry. So they're taking the lumber from the actual lumber producers. They're just transforming it into 2x4s, decks, and then selling it to their big relationship, which is Lowe's. And so it's more of a midstream and distribution company in the lumber sector, not as cyclical as the others you get. So their margins are a little more stable. It's just about volume. And they've done a lot of good acquisitions in the United States to become one of the largest providers of these services there. So yeah, this is one that, and if the housing market turns, I think it could go to $15 pretty easily. But if not, we'll just collect our 5% and let them continue to compound.
For sure. Okay, we're going to take another quick break right now. When we return, though, we'll take a look at some of Jamie's past picks. That's next. Stay with us. Welcome back. We're going to go through some of Jamie Murray's past picks now. So these are from about a year ago, July 28th, 2025. Your first one was Broadcom, recommended at $294, now at $414. So total return of 41%. It's did quite well. Are you still holding this one?
Yeah, we love Broadcom. We've owned this stock since 2017. I think split adjusted, that's like a $70 entry price. And so this is one that we've held, through COVID, through the AI boom. And the AI stuff really it came a little bit out of nowhere to investors in Broadcom 2 or 3 years ago. But now it's not neck and neck with NVIDIA, but it's firmly in the second place in terms of semiconductor companies that can provide these, they call them custom ASICs. NVIDIA calls them GPUs. They are different products, but they really do the same thing. It's to run the AI models. Okay. And so Broadcom's big partnerships are with Google and Meta. And so they're using, leaning into Broadcom to build chips. Broadcom can design them and build them a little bit cheaper than what NVIDIA sells them for. So it gives a secondary option for these companies. And then, on top of that, this is just a company that historically has made really strong acquisitions. It's a very cutthroat culture. Like they'll buy a software company and, immediately start to raise prices, lay off some of their redundant staff. And it's made for a really good financial model. And so that's been historically why I've owned it. But now it's all about the growth in AI. And as more and more data centers get built, they'll sell more and more product.
I think the next one is a similar story then in terms of the growth in AI, and that's Qualcomm. So recommended at $161, now at $238, return of 48%, total return of 50%. Similar story here, where it's kind of just getting started for this company?
So similar. They're both semiconductors. Qualcomm's historically been the largest smartphone semiconductor company. So almost every smartphone chip or smartphone in the world has a Qualcomm chip.
Interesting.
Or they have to pay a patent or a royalty to Qualcomm because they own all the patents for this. So it's a really good company in terms of mobile. But the reason why the stock has had this huge move over the last month and a half is because of AI. So they're starting to build out some competitorships to Broadcom and NVIDIA as well. And they revealed they have their first order for it, and that's really what's taken the stock up. This was always the lowest PE stock in the semiconductor space because...
Why?
It was low because first they had a bunch of business with Apple, and that business was rolling off, like Apple was bringing it all in-house. And then they also have some business in China, and some local Chinese companies are trying to steal market share. And so we've recently exited Qualcomm mostly on those concerns. But obviously, we always knew that there was some AI potential there lurking in the background as well. So we always thought this upside was sort of ingrained in the stock.
Interesting. Okay, your last one is an income fund, Chemtrade Logistics. So recommended at $11.23. Now it's at $16.78. Total return also on this one, 55%. Are you still holding this one?
Yeah, we're still holding this one. Chemtrade is one of the larger holdings in our income fund. And it's really just a company that they have a diversified mix of chemicals. What we're really excited about those, they have a water treatment business. So water treatment chemicals in the United States. These businesses tend to trade at much higher multiples than where Chemtrade was trading. And this is a company, it has a bit of I don't want to say a checkered past, but they've made some poor acquisitions historically if you go back 10 years. And I think a lot of investors just didn't really have this on the radar. Mm-hmm. And now it's starting to be a little bit more picked up by the rest of Bay Street. And we think, we have a lot of respect for the new management team that's running it. And we think that it has a good another 5 years executing the same strategy.
What do you mean by, when you talk about water treatment for Chemtrade? What are they treating? So
they're treating like the drinking water and wastewater. And so that's a very stable, predictable business. There's the chemical sector, there's a wide array of chemicals that get lumped into it, but they're all really micro economies and micro markets. So we always thought water treatment was one of the lower risk chemicals. So you're really selling to municipalities. Everybody, no matter what's going on in the economy, people need fresh water, need to treat wastewater. And so Chemtrade they bought up a bunch of companies in the United States, and they're rolling them up and now they're really the leader in that. And those, as I was saying, other competitor companies traded at much higher multiples to reflect the growth and economic strength of those markets.
Okay, we're going to take a quick break right now. We'll be back, though, with Jamie Murray of Murray Wealth Group, taking your questions on global equities right after this. Stay with us. Welcome back to Market Call. Jamie Murray is here taking your questions on global equities. We'll start with an email question, this one coming in from Christine, and it reads, I'd like to ask the guest expert about CNQ. Thoughts on CNQ at this time? It's been a bit of a rough road.
Yeah, so it's had, we're talking about CNQ, Canadian Natural Resources. Yeah, I mean, they've benefited from the oil price moving up, but they did have a bit of a bumpy start to the year when the Venezuela news came out. But this is a company, I mean, we own this in our income growth fund. I think a lot of other guests will echo my similar sentiments. It's just a phenomenally well-run company. They have a huge reserve base in Alberta. And, it's one of the best operators out there. And it's a very counter-cyclical management team. So it's not necessarily going to be the best performer in an oil bull market, but it will probably be the best performer in an oil bear market. And so if you're holding this for just a long-term investment, you'll get probably a higher total return out of Canadian Natural Resources than some other more higher cost companies that can really take off during these bull markets, but they might not have the management team or the strategy or the asset base to handle an oil bear market. And so, right now with oil prices at 100, everybody's feeling good in the oil patch, but yeah, we will continue to hold it and buy it today.
It sounds like a company like this, correct me if I'm wrong, you're looking for, good quality companies at the moment that can do well in the long run and have steady earnings growth. Would this be one of those, or?
Yeah, exactly. Like they'll acquire companies when the market is poor at good prices. They'll reduce debt and pay dividends when times are good, like what they're doing. And really, as we were saying at the top of the hour, the oil prices are very volatile. They could fall to $80 in 2 weeks if the Strait of Hormuz actually does open, and we'd be comfortable holding Canadian Natural Resources despite anything like that.
Okay, we'll go back to the phone lines now. Nick is calling in from Chilliwack, BC with a question. Hi there, what's your question?
Hi, Lindsay. Thanks for taking my call. Congratulations on your new job. Jamie, I'm in National Bank, and I see the banks, the top three banks, are all going really high. Is there any concerns with drawback on those, in particularly National?
Okay, thank you for that question. Obviously, watching banks closely this week, National Bank in particular.
Yeah, so I mean, all the banks are reporting this week, and all the banks are hitting all-time highs, I think, without having to go through the charts of each one, but they're all seemingly pushing higher and higher. And I mean, I think count us in the camp that's a little bit confused by the move we're seeing in Canadian banks. We've been reducing our exposure to them. We own TD and Scotia, but I think they're all a pretty similar group of companies, and it's really hard to say which one is your favorite over which. So we just like these two for their dividend growth historically and some upside that we see in TD and Scotia. But yeah, I think as the whole group is really rallying, we've been reducing our exposure, and even talking to some other investors and analysts on the street, they're all a little bit perplexed with this move. So
why is that? Like, what did you expect to see happening with the Canadian banks?
Sure. So I mean, in Canada, we have a slowing population growth. We have house prices and some housing stress in some of the major markets in the country. Unemployment's high. So we're not really seeing, and on that side of the business, a lot of strength. Now, obviously, the capital markets, the TSX had a phenomenal year. And we've heard that there are actually some international investors that are looking to Canada to pick up the banks, probably after maybe a decade of pulling capital out of Canada as money comes back in. The banks are one of the natural places for that to flow. So I think that's a possibility, and capital flows can drive a lot of stocks in the short to medium term. But yeah, the PE ratio for all the banks are much higher than historical averages, and that's one of our main indicators that we look at. And so that's why we're saying, we thought maybe even 10, 15% was how high they were going to go, and they just keep on pushing higher.
Wow. Okay. We're going to go back to the phone lines. Luke is calling in from Montreal with a question. Hi, Luke.
Hi, Jamie. A quick thought about Air Canada. I read recently the report of your colleague Michael Aikes, and it was a very positive report. So, what do you think Air Canada need to reach the target price around $23, $25 quickly in 2026?
Okay.
Thanks.
Thank you.
Yeah, so again, travel stocks, airlines are very economically sensitive. And so when we see slowdowns in the economy, oil prices spiking, that can create some havoc. We actually think Air Canada is better positioned relative to other airlines around the world, just given we have much more secure energy supply in Canada and where Air Canada typically operates versus other global peers, potentially like Asia and Europe. So they're a little bit advantaged there. And we like Air Canada because why we've owned it is like the stock hasn't really moved in 3 or 4 years, but they're building out a very strong global network for flying from Asia and from Europe into the United States, actually. And so they're going to use the Canadian cities, Toronto, Vancouver, Montreal, as their hubs. They have a brand new fleet of aircraft coming in from Airbus for optimized for flying from, say, St. Louis to Montreal and then Montreal to Nice in France. And so it's going to be very unique routes that a lot of other carriers don't have. And ultimately, we think it trades at a discount to the U.S. guys, and that should close. So we think there's a lot of upside once the economy allows Air Canada to perform.
How important is it that Air Canada finds a new CEO quickly, though?
So certainly that's going to be the next major catalyst for the stock. I mean, if they bring in a great CEO, that's going to give the market a lot of comfort. Operationally wise, we think they have a very strong bench. There's a good management team that's been there for over a decade who know how to run the business. But certainly, navigating the 2030s and beyond is going to be the next big question for Air Canada.
For sure. Okay, we're going to take a quick break right now. We'll be back, though, with Jamie Murray of Murray Wealth Group, taking your questions on global equities right after this. Welcome back. We're going to go right to the phone lines. Robert's calling in from Burlington, Ontario, with a question for Jamie Murray. Hi, Robert. What's your question?
Good afternoon. Just a quick shout out to those holding Well Health Technologies. Just hang in there. That company's just getting started. Jamie, I hold Restaurant Brands International and McDonald's. They're both huge companies. Artificial intelligence and robotics, I think, are going to come into play here pretty soon. The consumer, I think, will be in way better shape come September. What are your thoughts on international brands right now, and where do you see it going? Thank you.
Okay. Thanks, Robert. Thoughts on international brands?
Yeah. So, I mean, this is the owner of Tim Hortons and Burger King, Popeye's Chicken as well. So you're looking at these brands and seeing, are these going to be leaders moving forward? I think they've done a really good job with the Tim Hortons franchise in Canada.
Yes.
They've really reinvigorated that brand over the last couple of years. And so now the focus is on Burger King, which is a much larger brand and probably a little bit more competition, harder to reinvigorate. But the last quarter they put out, they actually had pretty good results in the Burger King brand. So
I think it's Popeyes that was still struggling a little bit.
Yeah, and Popeyes used to be the crown jewel, and everybody started having chicken sandwiches, and then now everybody does. Yeah, but we don't own it. It's certainly getting more interesting, though, if they can get Burger King moving in the right direction. We actually don't really own any QSR companies right now. We did own Starbucks up until about a month ago, but we sold Starbucks because we were worried a little bit about the consumer and oil prices, and do I need that $7 latte? But Tim Hortons is a little bit more affordable, so not as concerned about the consumer in that regard.
Okay. Another caller now from Burlington, Ontario. This is George calling in. Hi, George. What's your question?
Thanks for taking my call. Jamie, in the past, you and your company have liked now called Vital Infrastructure Property Trust Do you still own it? And what's your current opinion? The last quarter seemed to be a bit lackluster. I'll hang up and listen. Thank you.
Thank you.
All right. Yeah, thanks, George. So Vital Infrastructure, it used to be Northwest Healthcare. This is actually now our largest position in our income growth fund, so we still really like this company. Last quarter, it was fine in our books. I mean, it's a pretty stable company. They lease out to medical office buildings and hospitals. And for the first time in 3 or 4 years, they're actually starting to grow. They went through this balance sheet property rationalization strategy, and now they're actually growing and buying really high quality or even developing high quality assets that we think are going to drive a very good multiple for them. So we really like this stock. We think it should be trading at $7.50. And while you kind of wait for that price target to come into play, it pays a 6.5% dividend. So one of the higher in the market that we can find.
Okay, back to the phone lines. Kevin calling in from Kingston, Ontario with a question. Hi, Kevin.
Hi, my question's on Visa and MasterCard. They're both the same, but I've noticed both have been struggling for the last couple of years. I've been an investor in both of them. Back and forth, I switched for about a year after their IPOs in 06, 07, 08. But their charts have not performed like they have been after all these years, and I'm wondering what's going on. I heard that Warren Buffett sold all his Visa and MasterCard in January, so I'm just wondering, is there something that I don't know yet? Thank you.
Okay, thanks for that.
Okay, yeah, so Visa and MasterCard, the two credit card companies, are both always being considered like some of the crown jewels in the market, some of the highest quality companies out there. And I think for the first time, it's really the rise of both like agentic commerce, so having bots do your purchasing for you. They don't really care how they're transacting. They're just going to find the most cost-effective way for the consumer. And then digital currencies as well are starting to gain a little bit of traction as sort of an alternative to Visa and MasterCard in terms of how you can pay. Now, it's still very small, 1% to 2%, and Visa and MasterCard both have strategies for digital payments as well to monetize that. But really, it's just been the valuation on these companies has come down over the last, call it 2-3 years. I think MasterCard used to trade around a 30 times multiple. Now it's trading around a 24 times multiple. So it's really just been some multiple compression. That can only last so long. The underlying earnings and operations are still very strong. So we'd be buying. We own MasterCard. We don't own Visa. We agree they're very similar companies. You probably you can get away with owning one. But we prefer MasterCard for a little bit higher growth.
Okay. Now we've got Patrick calling. I'm not actually sure where Patrick's calling from, but hi, Patrick. What's your question?
Hi, Jamie. I have a quick question for you. It's concerning CGI Group. It's been sluggish for, I would say, the past 5 years, and notably the past 2 years. And also, I'd like to hear you on Fairfax Holdings. Thank you.
Okay. We'll start with CGI Group. Thanks for that.
Yeah, so CGI, this is a consulting company. They do a lot of work, I mean, globally, but specifically in the U.S. Is, I think, their largest market. And they do a lot of work, as most consulting companies do with the U.S. government. And this company is just one of those AI casualties. And interestingly enough, companies are now being lumped into AI winners and AI losers baskets. And it's really some of the investment banks are even saying, you can just buy the AI winners basket, send us an order, and we'll just buy these companies and we'll short the AI losers. And so consulting companies have all been lumped into that. So we own a company called Accenture, which is a larger version of CGI effectively. And it has a very similar share price chart. But I met with the Accenture management team a couple of weeks ago, and they're not really seeing any effect yet from AI. CGI, I don't think they're seeing much of a slowdown either. It's really just a little bit more of a general slowdown across the economy as companies navigate how do we allocate our tech dollars towards Anthropic and OpenAI or to CGI or what project we're going to start. So I think it's a cyclical factor that's really holding these companies back. And ultimately, I think as they show that they can grow while the AI economy grows, you'll see the multiple tick up, you'll see the earnings improve, and you'll see the stock prices do better.
Okay, we got to take a quick break right now, but when we return, we'll take a look at some of Jamie's new top picks. That's next. Stay with us. Join us tomorrow on Market Call. Ryan Modesto will be on the show. He is CEO and portfolio manager at I2I Capital Management, and he'll be taking your questions on North American stocks. And it's time now for top picks with Jamie Murray. So we'll go through these one by one, of course. Meta Platforms is your first top pick, one of the big ones.
Yeah.
What do you like about this one?
Yeah, so I mean, we like all the hyperscalers, the Amazons, Microsofts, Alphabets. But I think Meta maybe has the most upside over the next 12 months. The stock's now trading at like an 18 times PE ratio, so below the market in general. And if you look back over the last 5 years, Meta's actually taken by far the most incremental advertising dollars, more than Alphabet, more than Amazon. It's growing its advertising business. I mean, it grew, I think, 23% last quarter or something like that. And this is a company that's doing $250 billion in revenue, 3 billion plus users worldwide. And so we just think as AI continues to, again, permeate through the whole economy, Meta is going to be one of the biggest beneficiaries of this rollout. And that's really why the stock has been knocked down, is because investors are saying, you're spending too much money on AI. You're not giving enough back to shareholders in terms of buybacks or dividends. But ultimately, I mean, if you look at the guy running the company, Mark Zuckerberg, he's the youngest 100 billionaire person in the world for a reason. I think, we have a lot of trust that the direction they're going is a good one, and that they're making bets that are going to pay off in the long term.
Is there a timeline, though, for when investors should start to see some results from all this spending?
So I think they already are. I mean, I think that's what's driving the revenue growth. And they have all these AI advertising platforms where you can just tell Instagram, hey, I want to sell 100 T-shirts, make my ad and do it. And they'll say, okay, we can do that for $50. And you say, sure.
Right.
Click a button and you sell your 100 T-shirts. That's simplifying it a little bit, but they're using AI already in the core business, and now they're going to expand into new products to continue to grow.
Okay. Also, your next pick is Uber. What is it that you like about Uber?
Yeah. So Uber, I think the most listeners at home know what Uber does in terms of the ride share and Uber food delivery. Those businesses are humming along. Cash flows growing year over year. Revenue still growing nicely. There are more and more users. They have a membership program called Uber One that is getting more and more signups every year. So everything is great with the core Uber business. Why the stock hasn't really worked is, over the last year at least, is that investors are now worried about autonomous vehicles like Waymo and Tesla. Arguably a better quality product. People who've ridden a Waymo love Waymos. And they're worried that Uber is going to be left behind as these new forms come into play. But I mean, Uber is not standing still. They have AV partnerships with, about a dozen startup AV companies. I've met with 3 or 4 of these private companies that they're investing in, and they're all super, super impressive. They have funny names like Wabi, Neuro, Wave with a Y. So all these tech startups, but over the next 12 months, I think Uber, you're really going to see them roll out a lot of these launches, and you're going to see Uber become a solid player in the AV marketplace.
Last up is Flowserve. Maybe explain this one and why you like it.
Yeah, so Flowserve, what the name says, they flow and they serve. So they sell pumps and valves, and they sell these to large-scale industrial plants. What we like about them is they're one of the largest players in the nuclear sector. So nuclear power plants use a lot of their products. As well, LNG is a big sector. And, general industry. I mean, they sell right across the board, but those are 2 of the big growth drivers for the next, call it 5 years. And what we like about them is they're going through this margin improvement strategy. So they used to have, thousands of products. A lot of them did the same thing. They had similar specs, and they're consolidating those products into a smaller product shelf. That's going to increase the margins. And I mean, it's one of those razor blade models too. It's not just selling the part for the first time to the nuclear plant, it's then selling and servicing the parts on the plant for the next 50 years. So it has a long tail of work that they're going to do. And the stock sold off pretty hard after their last quarter. But I mean, this is a company we think is going to do well with the oil and gas and nuclear buildouts that we're seeing.
Okay, we'll leave it there. Jamie Murray, great to have you in today. Thanks so much for joining us.
Yeah,
Appreciate
thanks for having me.
And thank you for watching Market Call. We will see you next time.